Paul Sankey is back to discuss. Welcome, sir.
Hello, Kelly. How are you?
Just connect the dots for us quickly. What your reaction to Netflix is, I don't want to call it an implosion, but why you think that means energy, which is shriveled to 3% of the market, could still grow substantially from here.
Well, the long term, the most important is the cost of capital. I think this is the most underanalyzed part of the market from the point of view, certainly, of analysts. The market actually self-analyzes it and does a brilliant job, and that's kind of what it's doing with the overall NASDAQ versus the S&P, for example, where it's implying, obviously, the Fed raising rates, the cost of capital going up, and the value of equity, therefore, goes down if returns don't keep up. I hope I'm making sense.
Yeah.
So when you additionally cut for example, Netflix's returns outlook, you really have a double whammy where you're looking at a much, much lower equity value. And it could be for any tech stock based on the fact that your anticipation of a lot of future cash flow gets massively cut. And then in the context of rising cost of capital, your equity value gets cut even more. And that's basically what's happening with some of these names that were very highly valued at very low interest rates, very low cost of capital, with a very strong outlook because of COVID and people watching internet TV and so on. Now that's radically changed. And at the same time with the oils, what you're seeing here is very strong cash generation and very strong cash return to shareholders in a tough market with buybacks. That's going to make them outperform. Let's
talk about the oil price. I'll go ahead and ask for another call on this one. It's really kind of fluctuated, hovered around the $100 a barrel mark for the last couple months or so since that big spike. Where do we go from here? I mean, do you see it going structurally higher? Does it matter? Do you think the energy can be 10% of the S&P even if we kind of stay at current levels or even go lower?
I think, generally speaking, the argument is that when oil prices are rising with demand rising, you will outperform the S&P 500. But I think that at the moment, the free cash flow of the oil equities is so high, the free cash flow yield. We're talking about stocks here with 20 and 30% free cash flow yield. Wow. Compared to the market as sort of 2 or 3%. There's a lot of power to that. And all of that's really considering about $80, $85 oil. So, at 100, we're definitely doing just great. I was smiling because I remember, I think it was last time I was on, you were saying it's been pretty calm in oil recently, Paul. And I was like, what are you talking about? But, the big one at the moment, Kelly, which is really tough, is the China COVID situation. I mean, that one is an absolute head scratcher, and that's obviously huge for demand. We think there may be 2 million barrels a day of lost demand right there, which is a big deal. But again, you assume that's going to come back. And then we had, for example, last week, the Delta Airlines CEO talking about very strong demand for jet travel and transatlantic and business travel. So there's actually more demand to come in a high price environment, and that's very powerful for the outperformance argument.
Yeah, as China hopefully reopens and normalizes here, it's not like we have a big supply lever that we can pull. So are oil prices going to spike again?
There's a risk of it because, of course, as you know, this is with the governments pushing out a lot of strategic emergency reserves. And, we're still at 100 plus oil, even with that additional oil. And there's actually quite a long way to go through the emergency reserves, but the market will get increasingly nervous about that as a sustainable supply source. And at the same time, the truly sustainable supply, which is going to be things like Saudi Arabia or the US, is very questionable in terms of how much more it can grow. So, for example, yesterday we had the Halliburton CEO on his call saying, I think we're maxed out on fracking capacity in the US right now. You can't make oil production without fracking. And so it's really saying that there's not going to be a whole lot of a great acceleration in US growth, despite the very high prices.
So finally, let's talk about your favorite places to be in the energy space right now. Is it still the refiners?
Yeah, I mean, everyone who does oil is really thrilled about refining at the moment, not just the short term, but also you've shut a lot of refining capacity. So we think this is a structural move. And you also lose a lot of refining capacity in Russia, assuming that doesn't come back. So it's actually a longer term trade than just the usual, let's buy them into driving season. So that's one area. And then, of course, if you're saying oil's going to 10% of the S&P, you kind of love them all. So, whether it's a US E&P, a lot of them are much better companies with much better strategies. Exxon will do very well with high downstream earnings as well as high upstream earnings. The list kind of goes on.
All right, we'll see you for 2 for 2. Paul, it's great to have you back. Thanks so much.
Shepard Smith here. Thanks for watching CNBC on YouTube.